All right. Well, we just want to thank everyone for joining us today. We've been getting a number of questions from wealth management clients, from media, from subscribers, from general public, just around things like tariffs, inflation, recessions, market volatility. And so John and the team thought it'd be a great idea to just put together a webinar today, and we're calling it the 3 Market Myths Debunked, and then we'll have a Q&A. So on the Q&A side, starting even immediately down towards the bottom of your screen, you'll see a Q&A button. And so if there are any questions that you want to ask, just click on that and put your question in. We will get to as many of the questions as we can, as we normally do. Any questions that we can't get to, we'll either respond directly back to the sender of that question, and in most cases, we will also reply to it on the blog on the prudentspeculator.com. After this, if you have interest in any of the information that we share or any of our reports, sometimes we get questions around wanting to know more about our wealth management services. You can reach out to info@theprudentspeculator.com. That's the email address, info@theprudentspeculator.com. Or you can see down here at the bottom right of the first screen, you can email me directly at jclark@covitz.com. So either way, and I'll go back over that before we're done. And so with that, I'm going to hand it over to John Buckingham, Principal Portfolio Manager and the editor of The Prudent Speculator. And John's going to lead us off with a presentation.
Terrific. Well, thank you, Jason. And I think it's a very timely period to be discussing some of the things that we will address on this webinar. The nice thing also about this is we have a third member of our investment team, Chris Quigley, who is going to join us for Q&A. Chris was the primary author of our AI paper, and so he's kind of our resident AI expert, and so it's nice to have him on the call as well to answer any questions that may come up at the end. So before I begin, it's probably timely to remind folks of one of our slogans that we live by, which is the secret to making money in stocks is not to get scared out of them. Times like this certainly cause some consternation for folks. You know, the Dow going down 600 points one day, up 600 points the next. I guess we're back down about the same amount we were up yesterday. So there's tremendous volatility, but we try to stay on an even keel. Don't get too high about the good times. Don't get too down in the dumps about the bad times, because we truly believe that time in the market trumps market timing, and that those who can stay the course through thick and thin will benefit. We know that there's plenty of media headlines today, lots of scary things, but I think it's good to provide some perspective. Legendary value investor Warren Buffett said what I have up on the screen. He said it about the 20th century. We had all sorts of problems, 2 world wars, depression, recessions, financial panics, oil shocks, a flu epidemic, believe it or not, and the resignation of a president. And yet the Dow rose from 66 to 11,497. We could probably, say a lot of the same things here since the year 2000. And we can see what the Dow has done since that Buffett quote, which was, remember, it was 11,000 and change back then. Now we're 42,500, somewhere around there as of this moment. So stocks have managed to overcome all sorts of scary events. And those who are subscribers to the newsletter or read our stuff know that I like to use this chart frequently. Essentially shows all of the bad things that have happened, including 9/11, this 1987 stock market crash. I wasn't alive for Sputnik, but there's all sorts of events that have occurred, and then you can see what stocks have done since then. And, on average, scary events, you'll see some declines in the market, but they're often short-lived. And on average, this is the S&P 500 on this chart, on average 12 months later, after all of these things have occurred, an 18% average return over the next 12 months. And that doesn't even include dividends, which would add to the total return. So this is just, again, trying to show perspective that bad things, scary things, disconcerting things have occurred, and yet the equity markets have managed to overcome every one of them in the fullness of time. Now, that doesn't mean there won't be volatility along the way. We are now in the middle of, depending on the index you want to talk about, we've had a 5% pullback from the recent highs. I know it's a little more than 5% in the S&P 500, but these kinds of declines happen frequently. On average, 3 times a year, you'll get a 5% pullback. So again, I don't never want to minimize market volatility or paper losses that have occurred in the last couple of days. But if a 5% decline is causing somebody to lose sleep, they really need to rethink their commitment to equities. And I know that may sound harsh, but because 5% declines happen 3 times a year on average, you have to be braced for them. 10% corrections happen every 0.9 years, or roughly every 11 months on average. So we're likely to have a 10% decline, within the next 12 months. It happens. Even bear markets, 20% declines happen every 3.4 years. So volatility is normal, but the good thing about volatility is there's also upside volatility. And with the same frequency, you'll see that there are gains of comparable or greater magnitude. And it is greater magnitude because over the long run, stocks have delivered fantastic returns, roughly 10% to 13%, depending on whether you're investing in growth stocks or value stocks. So equities historically have been the place to be, but you have to put up with volatility. And the challenge for many investors, of course, is navigating through that volatility. And maybe my favorite quote is from Vannevar Bush: "Fear cannot be banished, but it can be calm and without panic. It can be mitigated by reason and evaluation." So we know that history doesn't repeat, but as Mark Twain says, it often rhymes, right? And certainly past performance is no guarantee of future performance. We don't know what's going to happen in the future, but many of the things that have occurred have happened in the past. The things that we're worried about today have happened in the past. So, what are we worried about today? That's the point of this presentation. So I call it, this section is reason and evaluation, helping us to look at what has happened historically when markets have been worried about various events. Now, obviously today, investors are worried about tariffs. And there's plenty of uncertainty about tariffs. We have had big market moves as the tariffs have been implemented or threatened, and then there have been exceptions made or delays made. So there's really a lot of uncertainty about what will ultimately be the impact of tariffs. But we've dealt with tariffs before. Back in 2018, President Trump launched a quote unquote trade war in March of 2018. Those tariffs that were put in place then were continued by the Biden administration, many of them, and now we have new tariffs. But the point of talking about tariffs is that if you look and see where markets are up something on the order of 80% or so since that first tariff, big frightening event happened back in 2018. Or I shouldn't even say frightening, because some people may say that the tariffs are not a bad thing if they're properly implemented and they ultimately reach an objective that hopefully enriches our country and maybe it gets the entire world to think more about free trade, because of course foreign countries do have tariffs on US imports as well. So the point of this is that we've dealt with tariffs for a number of years, since 2018, frankly, and equities have managed to appreciate in value in the face of tariffs. The concern for many investors with tariffs is that we could have a recession because tariffs ultimately are a tax, and ultimately the consumer is likely to be the one paying that tax. And so the worry and from the financial media is that we may have a recession. The tariff war, skirmish, battle, whatever you want to call it, could cause a recession. Well, the reason for that, and the primary data point that folks have pointed to, is the Atlanta Fed every few days makes a forecast for real inflation-adjusted GDP growth. And remember that a recession is 2 quarters of negative real GDP growth. So believe it or not, in the last week, the Atlanta Fed's Q1 2025 forecast for GDP went from a positive 2.3% to negative 2.8%. And today the economic data was a little better, I guess, than folks were expecting. So now it's minus 2.4 with the new estimate. So that's going to fluctuate all over the place. But the concern for investors is, do we have a recession coming? And then the natural question I would ask is, well, a recession sounds like a bad thing, but we want to actually look at the historical evidence to see what has transpired when we've had events such as a recession. Or the other thing that has gotten some news attention here of late is the yield curve. There's been an inversion of the yield curve where the 10-year yield minus the 3-month yield is now negative. So the 3-month yield is yielding higher than the 10-year. And this has happened before in history, and in the past, the quote-unquote experts will tell you that means a recession is likely. So we have the Atlanta Fed telling us there might be a recession. We have the yield curve inversion suggesting that there might be a recession. And oh, by the way, the yield curve inverted back in 2022, and the media was talking about how there was a recession imminent, but we didn't have a recession. So, you take everything you hear and read with a grain of salt. So again, we have the ability to crunch lots of numbers. And when you look at the table there, you can see here's the return going forward on a 1-year basis for the S&P 500. Now, this is total return. When you have a yield curve inversion, we've had a 9% positive return. So if somebody is saying you should sell equities because of the yield curve inverting, the historical data, while certainly anything can happen and there have been negative periods, on average, a yield curve inversion is not a reason that people should be parting with stocks. And here again is the data. And obviously, if you look out to, where the present is, we've had massive returns for those who've lived through and not panicked, during previous yield curve inversions. Now, the question is, are we going to have a recession? Of course, nobody knows. The economists don't know. As the joke is, stock market has predicted 9 of the last 5 recessions. We like to amend that and say economists have also predicted 9 of the last 5 recessions because nobody knows. So the current odds, if you will, and Bloomberg tallies this on a daily basis, they are suggesting that the risk of recession today is 25%, which is historically about average for that measure. So we're not even thinking that there necessarily will be a recession. Again, anything can happen. We don't know the impact of tariffs. We don't know the impact of consumer behavior going forward. But the bottom line is the odds are a little higher today of a recession than they were, say, a week and a half ago. Now, we also have to remember that the economy has grown over the long haul. And when we talk about a recession, we're talking about real, meaning inflation-adjusted numbers. So the thing that people need to understand is that corporate profits, corporate earnings are measured in nominal, actual dollars, not in real dollars. So even if you have a quote-unquote recession based on real GDP growth declining 2 quarters in a row, that doesn't necessarily mean that the nominal GDP is actually going to drop. And you can look at this chart, it's the blue line. See, when the Trump trade war in March of 2018 began, the overall GDP was about $20 trillion. Well, today it's $30 trillion. And so the economy is likely to grow on a nominal basis. Corporate profits are likely to continue to grow. Obviously, there certainly could be some interruption in that growth depending on how the tariffs are implemented and folks react to it. But the moral of the story is that the U.S. economy has grown over time and is likely to continue to grow, even if there is a short-term hiccup, if you will, in the year-over-year real, meaning inflation-adjusted growth rate. Now, corporate profits have grown over time. One of my favorite charts is the one on the left there that is showing the S&P 500. And if you see the green line, the periods where it has a decline generally correspond to a earnings recession, not necessarily a GDP or an economic recession, but an earnings recession. Those are the blue bars. So where you see the blue bars kind of head south, that's when you see stock prices often head south. Of course, the blue bars are rising as they move to the right over time. And so we continue to believe that we will see corporate profit growth, even if those estimates that you see on the right side of the screen are likely overstated. And keep in mind, these estimates are from Standard & Poor's for the S&P 500, and they're presently estimating fantastic growth for 2025. And again, great growth for 2026. Now, these were all pre-tariff, if you will, so we don't know the impact of tariffs, but if I were someone having to make an estimate on the S&P, I would probably be lowering it down for 2025 by a bit, but I still think we will see overall earnings grow this year versus last year. So this is the money page, if you will, for recessions, because you say, okay, John, maybe there won't be a recession, but what if there is? And the natural thing I would say is, well, let's look at what's happened during previous recessions. And we've had them before, and we will have them again. They haven't been outlawed, even though we haven't had many of them in recent time. But if you look at the data, and we look here at value stocks and dividend-paying stocks, because those are the things that we invest in, 1 year prior to a recession, we've had, again, solid returns of 8 to 9%, positive on average. And then if you look at the post recession for those same things, dividend payers and value stocks, you can see fantastic, 1 year forward returns when the recession ends. Now, the problem is we don't know when the recession officially begins or when it officially ends. And frankly, the entity that decides this doesn't know. They only know with the benefit of hindsight as to whether the recession, when it ended and when it started. So the people who tabulate when recessions begin and end can't figure it out exactly. So to think that you as an investor can manage to somehow get out right when the recession begins and get back in right when it ends is a major undertaking. Now, if you could, again, the data is showing about the only chart we can find where it would somehow pay to be out of stocks would be from the start of a recession till the end of the recession. But again, nobody can figure out when they begin and when they end. And you do not want to miss out on the 12-month returns coming out of recession. So again, we think it's best to stay the course, stay invested, even if there were a recession, which, as I said earlier, we don't know if there will be. Now, the other issue that tariffs are causing for investors, the other concern investors have, is about inflation. So tariffs are ultimately a tax, and if you're paying more for this or that, corporations are likely to have to raise prices on what they're selling. Public's going to pay more, so theoretically there's likely to be higher inflation. And interestingly enough, last week we had an inflation reading that came out that was actually in line with expectations and kind of quelled some of the concerns about inflation. The Federal Reserve's preferred measure of inflation is the core personal consumption expenditure index, PCE, and that strips out volatile food and energy prices. But 2.6 is not that far above where the average rate of inflation has been. So inflation obviously has come down dramatically since it peaked, at least on the PCE, peaked up above 5.5% or so. So we're not certain that inflation is going to be accelerating. It hasn't been. It's actually been declining. Has been the trend. But we then further look and say, well, okay, what if inflation is likely to rise or fall? And the interesting thing here again is that equities, especially value stocks and dividend payers, have performed very nicely on average. Again, everything is on average because there will be negative periods in there as well. But the odds, or the historical odds, suggest that staying with value stocks, staying with dividend payers, even if inflation is rising, or conversely, if inflation is falling, stocks have proved to be a great hedge no matter what is happening with the inflation rate. So again, you shouldn't be dumping stocks because you're worried about higher inflation. If anything, you'd want to be buying stocks if you're worried about higher inflation. You know, this period of time, for many of the quote unquote experts, they've been comparing it back to the Paul Volcker years and the great inflation, because inflation hadn't been this high here this cycle since the 1980s and late 70s. So the interesting thing, and the reason I bring this up, is that we had high inflation. We had a Federal Reserve that had to take steps to combat inflation by raising interest rates significantly. You know, if you think the interest rates are high today on a mortgage, 7% mortgage, imagine back in the late 70s, early 80s, where you had, double digit and then some, mortgage rates. So it seemed like a very disconcerting time to be investing when you had very high inflation. You had a Federal Reserve that was fighting inflation. And in the process of that fight against inflation, the Volcker Fed we can debate who caused it, but Fed action didn't help the economy from a GDP growth standpoint. But we had two recessions in 1980 and 1982. And you can see on this chart here how stocks performed during this, again, inflationary period. Equities generated fantastic returns. Even if you invested in growth or non-dividend paying stocks, you still got a very good return over those Volcker years. And then the natural question is, well, what happened prior to that? Because aren't we sort of still in that phase of, we haven't really seen high inflation now. If we're more worried about inflation, starting up again, and inflation has come down, of course, over the last couple of years. But a natural question would be, say, well, that's great, John, that 1980 to 86 were good years. But what about the 70s? Weren't those awful years? Well, we again crunch numbers, and the 70s were not great years if you were investing in growth stocks or in the quote unquote market, i.e. the S&P 500. But for inexpensively priced stocks, which would be low PE, or the reciprocal of that on this chart, which is high earnings to price, they had a 13.3% annualized return during the 70s. So this idea that high inflation is something that you want to be dumping your stocks is just not supported by the weight of the historical evidence. Now, I mentioned the Fed. Right now, the Fed has been easing interest rates, lowering interest rates. And that has been because they've made, substantial progress on inflation. So, of course, the natural question is, well, what if inflation, starts to rise again? Is the Fed going to start to raise interest rates again? So we crunch those numbers as well. And here's, with the Fed funds rate, which is the only interest rate the Fed technically controls. If the Fed funds rate is increased or decreased, you can see the subsequent 12-month returns, whether it was a 3-month rise or a 3-month fall in the Fed funds rate. And we look at that both concurrent, meaning it's how have stocks done while it happens, and then also subsequent, meaning it did happen, then how have stocks done. And again, the moral of this story is that equities have performed fine whether the Fed is raising interest rates or lowering interest rates, quote unquote, on average. And value stocks and dividend paying stocks have the higher returns. So again, we think that you want to be positioned in reasonably priced stocks in any environment, but especially in environments like this. And we also look at the 10-year Treasury, the yield on that. Same kind of scenario. If the stocks have done fine, whether interest rates are rising or falling, and value has long been the place to be when you have a rising interest rate environment or a falling interest rate environment. So again, the data, we think, helps you stay calm, unemotional during periods like this, because it has happened before. Yes, the natural statement is, yes, I hear you, John, but this time is different. And I will say every time is different. You never step in the same river twice, is a famous quote. I think Heraclides might have said it. But it's true. Conditions are always changing. So full disclosure, we don't know the future. That's just because the past was like this does not mean the future will follow. But we've been around a long time. I've been doing this since 1987, and every previous time we've gone through, again, periods where the media might be trying to frighten you out of stocks. The right course of action has been to stick with it. And we even think that where interest rates are today, that's an attractive level for value stocks. Value stocks are trading at much lower PE ratios, for example, much higher dividend yields than the market and growth stocks. And historically, of course, they do trade at lower valuations and higher dividend yields. But relative to where we are on interest rates, we think that stocks are still attractively priced today. And our portfolios in particular are even more reasonably valued than the major averages and most of the value indexes. So we have lower PE ratios, lower price to sales, and higher dividend yields than nearly all of the indexes, aside from the S&P 500 pure value index. So we think that value is the place to be, and we think that keeping the faith during turbulent times is the way that investors will reach their long-term objectives. And of course, they should have already, prior to market turbulence, had their asset allocation mixes properly set so that they can emotionally navigate and financially, navigate through the downturns. Because, oops, I hit the wrong button there. Because the first rule of compounding is to never interrupt it unnecessarily. And that's why the asset allocation is so important to the equation. You want to have that set properly so that you're not being forced to raise cash today to pay the bills, so to speak. You should have all of that set up and budgeted well in advance, and your equity money should truly be long-term oriented. So with that, I'm going to put a few of our disclosures up there so you can read all of that. And then I will turn it over to Jason to talk a little bit about what we do here, and then we'll move on to Q&A.
Thank you, John. I know we always get a lot of feedback, the appreciation for the data points that you share during the presentations, as well as tables and images. Just helps bring everything to life, and also sometimes to cancel out all the noise that we can get reading papers and watching TV and listening to the talking heads. We've had a number of questions roll in, and so I want to remind everybody as we get ready to walk into the Q&A, at the bottom of your screen, you'll see a Q&A button. If you have any questions, please just type it in there. We'll get to as many of them as possible. Any of them that we can't get to, we will respond either directly to you, or most likely we'll put the response on the blog on the prudentspeculator.com. And if you have any questions that come out of this that you want to ask or you didn't ask, you can send that to info@theprudentspeculator.com. That's the email address, info@theprudentspeculator.com. The slide that John has open, we have a number of subscribers over the years have become private clients or wealth management clients of ours. And so this is kind of the structure of how we work. And so we have obviously an investment team, we have a client service team, and then we come together as one team to serve our clients. And I'm going to lead into a question that we got that just asked, and I'm going to answer it. And so one of the first question that we got was, how has your business structure changed in recent years after merging with COVID? And I thought that was a great question to go along with this slide. And that is, historically, and John will say often, we're stock people. And that's how our business was for a long time, just fully focused on the equity markets and the equity allocations of our clients. And so back in 2018, we saw a need for many of our long-term clients to be able to offer them much more than we had been. And as John brought up, asset allocation, so we needed more expertise in the fixed income area, maybe alternatives, and then just other wealth management services like financial planning, retirement projections, insurance reviews, estate planning reviews, and a number of things like that. And so that was a driving force for us to merge with COVID. So we got to partner alongside some really great and smart people that had already traveled that path, and they were able to evolve and expand our offerings and services for our clients. And so we've gotten great feedback from that. And so that is, if you want to know more about that, you can go to info@theprudentspeculator.com, or you can reach out directly to me at jclark@covits.com. So enough about that and into the questions. First one for you, John. The recent increase in volatility has begun to concern me. How can I better navigate these times? What is your team focusing on with this heightened volatility?
Well, I'll start it with a quasi joke. When I first started here in 1987 with Al Frank, markets were volatile then, just as they are today. And what Al would tell people to do is to go to the movies. Don't watch the market. If you're truly investing for the long term, volatility should be the friend of those who are seeking to buy, undervalued stocks. And I get that many people already have their portfolios established and they may not be in a buy mode, but navigating through the downturns is the secret to success. And, candidly, as I pointed out earlier, 5% declines happen 3 times a year. So you have to be braced for that. So the only thing I can guarantee is we will have more 5% declines. We will have more 10% declines. We will have bear markets in our future. You have to be wired properly and equipped to navigate that. Doesn't mean you have to like it, right? And we've gone through very difficult times. If the pandemic is not that far removed, we're now 5 years, getting close to 5 years from the market bottom. But if you think about the pandemic, it can provide some perspective. Remember that stocks bottomed on March 21st of 2020. We didn't even have a vaccine until November of 2020. COVID was still with us and is still with us, and there's no cure, so to speak. It's still around. And yet stocks have provided sensational returns. It was the same thing, that Warren Buffett slide. We had a big flu in the 1900s, the Spanish flu, killed a lot of people. And yet equities managed to rally during the Spanish flu. So if we can survive the pandemic, if we can survive 9/11, we can certainly survive, Trump tariffs. We can survive no matter who's in office. We're apolitical here. We don't take sides. We try to navigate our portfolios through the, what we think policies might be. But we will get through this. Unfortunately, we live in a very polarized political environment. So people are, can be very, concerned about who's in the White House now or who was in the White House last year. But the right thing is to stay the course with the proper allocation, as you mentioned, Jason. Have that established and set up in advance so that the downturns don't cause you, to lose sleep at night.
All right, thank you, John. I'm going to combine 2 other questions we got here. And so one, should investors be concerned about the concentration of the S&P 500? And then adding that question, another question to it, should we be selling the big 7 or magnificent 7 stocks? So kind of maybe tackle both those together.
Sure. Well, I would say yes, and no. We should be concerned about the concentration of the S&P, more so because investors think they may have diversified their risk by having, you have an S&P 500 ETF, you have a NASDAQ ETF, and you'd be surprised at the number of portfolios we've looked at that they have a lot of positions in funds in them, but yet their concentration within those funds is extraordinarily heavy. So part of the reason the S&P 500 did so well last year was NVIDIA. NVIDIA had a phenomenal return. Well, why is the S&P 500 lagging behind this year? NVIDIA had a lousy return, or has had a lousy return this year. Now, there are other components as well that have been hit hard, and some have rallied. So the long-winded answer in a short-winded form is that you want to be a stock picker. I think that very strongly. Simply buying the index, while it certainly is not a bad thing to do, all things considered, if your choice is not investing, or investing in an index, I would choose the index, 100% of the time. But you have the ability to pick and choose if you buy individual stocks. And so we own some of the Magnificent Seven. We own Meta, we own Apple, we own Microsoft, we own Alphabet. So we own, 4 of the 7. And Oracle is sort of, some would lump that in, and Broadcom would lump that in because their market caps have appreciated a lot. So we own a lot of the quote unquote tech names. Of course, we bought them when they were inexpensive, and they generally speaking are paying us a dividend as well. So I think that investors should be careful. They should be moving out of the S&P 500. And if you like indexes, I would much more have the equal weight S&P 500 than I would want to have the S&P 500 due to that concentration risk.
All right, great. A lot more questions coming in. If consumers drive a large part, the question says 70% of GDP, and consumer confidence is sinking, or it's being reported it's sinking, then GDP will decrease, and so will the market. Or, what are your thoughts on that? And then just throw in too, like, who is answering these consumer confidence questions?
Right. Well, we talked about consumer confidence on a recent market commentary, the University of Michigan's study. And one of the fascinating things is that they actually show you the data based on political party affiliation. So believe it or not, when Biden was president, the Democrats were really optimistic about the economy and the Republicans were pessimistic. Imagine that. And then when Trump is president, the Democrats are super pessimistic and the Republicans are super optimistic. So you have to take the data with a grain of salt, right? But we also have looked at return numbers. So when you have low consumer sentiment numbers, historically speaking, that, believe it or not, has actually been better for stocks on a go-forward basis than when you have, super confident consumers. And again, it sort of makes sense if you think about it. If everybody's optimistic, right, chances are they've gone out and bought their stuff, and they've put more money toward equities. And then if everybody's pessimistic, they've gone the other way, right? And so then as things start to more return to a normal level, you get some pent-up demand, increasing interest in making consumer purchases and potentially moving money out of safer investments into stocks. And so we take consumer sentiment with a grain of salt. We don't discount it. And frankly, that's part of the reason the Atlanta Fed's numbers went from positive to negative. But we also have to remember sentiment is what people say. We need hard data to what they actually do. And that's a huge difference. If you ask, I can assure you that if you asked 100 investors yesterday, what do you think about stocks? They'd say, oh, I think there's great opportunity in the market. If you ask them today, oh, I'm really worried about stocks. Why is that? Well, yesterday we had a big rally, and today we have a big sell-off. Of course, who knows where we are today at this moment. But so sentiment we take with a grain of salt. But if you are thinking about sentiment, not just on the consumer side, remember we look at the American Association of Individual Investors, which is a sentiment poll every week going back to 1987. And we are now at some of the most pessimistic readings we have ever had on that survey. It improved a little bit this week over last week, got a little tinge more optimistic. But if you look at what's happened historically, when everybody is pessimistic, that's when you want to buy. You want to be greedy when others are fearful. And the second part of that is be fearful when others are greedy. But there's no evidence that suggests that equities are a bad investment, that you're going to lose money when people are greedy. It just shows that you don't make as much. But you always want to stick with stocks no matter what the masses are doing or saying. And frankly, it makes me happy when people are pessimistic because I think equity returns are going to be higher going forward.
Amen to that. So just a quick one for you, because I always mess with you about the length of your answers sometimes. So this one's going to be a quick one. Dividends, reinvest or take them in cash if the money is not needed. So do I automatic reinvest into the stock, or do I take them in cash? And then maybe talk just quickly about what we do.
Yeah. Well, what we do is we let the dividends accrue in cash, which allows us to buy additional names or buy more of selected names. We would rather do it that way. It's not wrong to reinvest dividends per se. It is more of an accounting headache for investors. And then when you go to sell something, sometimes you get the dividend that hits after you've sold. Now you got to sell the fractional share. And by the time you figure that out, then there may have been another dividend that hit on the fractional. So you got to sell that fractional as well. So it's just more of an accounting mess. But frankly, we would rather allow those dividends to accrue to us, so that gives us more capital and more ammo to be able to add additional names rather than reinvesting directly in the stock.
Awesome. Thank you. Yeah. And so, like you said, either new names or bring up names that maybe haven't had their day in the sun, as you like to say, or have gone through a bit of a tumultuous time. And so on that, we got a question around Civitas, so ticker CIVI. And that question was regarding Civitas, what are your thoughts? Company stock price seems to be declining more than other oil-related companies.
Yeah, it has, and Civitas has been a favored name. They, of course, made acquisitions, and the company grew from a small company operating in Colorado area. They've now expanded to the Permian Basin. They're a little more susceptible, it seems, to changes in oil prices. Their earnings were out last week. We wrote about them on our market commentary. The earnings were okay. The outlook wasn't as favorable or as positive as we might have hoped. And in this market environment, stocks that disappoint have been taken to the woodshed. One of the things we've liked about Civitas is that they've had a variable dividend policy. So there's a fixed rate dividend, which the yield right now is very high. And then they had rewarded shareholders with additional dividends. Back to that previous question, we've generated a lot of income out of Civitas. We didn't reinvest those dollars directly in Civitas, at the time. So we've got a decent return on it with all of the dividends we've received. Now, the other thing Civitas just did was they decided that they wanted to focus more heavily on debt reduction than on share buybacks or on giving us an additional a dividend. So nothing wrong with focusing on debt reduction. Obviously they made substantial acquisitions, and so that's probably the reason the stock has been hit a little harder. Is worries about the debt structure, worries that they're not buying back as much stock. Because believe it or not, they bought back a lot of stock just in the last quarter. I think it was 3 million shares they bought back. So we like Civitas. Definitely, if you don't own it, we'd be buying it today. We think that would be an excellent addition to a portfolio, provided you have the stomach to deal with the extra volatility associated with the movements we've seen in oil prices here of late.
Yeah, that's good, John. And like you said, I think they bought back about 3.5% of their stock. And then in that variable structure, one of the adjustments we like that they made was, like you said, they can use that whole variable component in a given quarter to buy back stock. So if the shares have been hit like they have, they can use all of that versus paying a cash dividend. If the stock rebounds, well, then they can go back to, if they have that extra variable dividend, they can go back to paying that in cash. So we've got plenty more. I don't know that we're going to get to all of them here in the next 15 minutes. One of the things that we got here was, based on your AI report, what are some, and Chris, I'm going to direct this to you. There's a two of them. So first one, after the DeepSeek news, I keep reading that not nearly as much will be spent on AI as originally thought. Should I be worried about that with some of my holdings?
Sure. So first, I wanted to mention that the DeepSeek news and AI is all covered on our blog. We just did a couple weeks ago, an investment insight on AI with a bunch of themes and topics related to that. So that is over on the prudentspeculator.com/blog and can be found there, and it's free for everybody. Related to DeepSeek specifically and the AI spending, in general, I'd be worried less about AI spending and more about the path to monetization of AI. I think that is a much larger topic that we're sort of missing. Even management teams are throwing out AI in their conference calls, and stocks just go up because they said something. And people aren't really paying attention to the fact that this stuff is expensive. Queries from AI are way more expensive than a simple Google search. And so a company like Meta or Google, who are using AI to help their ad platforms, even FedEx, well, maybe FedEx can employ AI to make package delivery more reliable, or avoid weather delays. That kind of AI application is really potentially very valuable, but the exact spend on that is totally different by company.
Okay. Let me just tack on another question, just staying on the topic. So what are some non-tech sectors? Because when people hear AI, usually they just go straight to tech, right? And it's NVIDIA and it's Broadcom and Meta and what you've mentioned. So what are some non-tech sectors or some specific companies that could see a bottom line benefit from AI over the long term?
I would say probably every sector. There
Okay.
are companies within those sectors that can do particularly well. You could have financial services do well because they can identify fraud. You could have industrials do well because they can identify machinery failing before it actually fails, or automotive companies identifying cars. So, hey, your so-and-so's wobbling inside your car. Maybe you should bring it in before you actually end up stranded on the side of the road. Healthcare, same thing. One important thing to note about AI is that it's generally backward looking. So it's really good at taking large amounts of data from different places and arriving at an answer or at a quasi prediction. But it's not so good at saying, well, here's what I think going forward, because you have to have told it a bunch of things about the past to inform that position. And what you tell it in terms of training it is a big factor in what you're going to get out in terms of the output. So I would say every sector has some potential to benefit from it, but I go back to the first point, which is that monetization is really the thing. And if you see a path to monetization, then they can spend any amount of money on it. So Microsoft has Copilot. That's $30 a month per user for an Office 365 license. That's a lot. But if another company's includes it in their dry cleaning service, and you're like, but it doesn't really help me, I'm not going to pay for that. Well, then that's an expense they probably didn't need to incur.
Okay.
I would just add on top of that a lot of our thinking around AI is picks and shovels. So we're focused on companies that are going to be involved in building out the technology. I mean, Chris mentioned some things, uses of the technology, but when you think about stocks like Broadcom and even NVIDIA, which we don't own NVIDIA yet, but we certainly are watching it. They're likely to continue to benefit. The fact that DeepSeek is here does not necessarily cause people to spend less money on infrastructure, if you will, of AI going forward. So we think there's a long runway where the investments will be made. But as Chris points out, ultimately you have to monetize. I don't want to say this is like the .com situation, because it is different. But back in the .com days, as Chris said, companies today mention AI and their stock might go up because they said AI 17 times on the call. Well, back in the tech bubble, you had companies that would add .com to their name. There was a company that sold fish oil called Zapata. I think it was fish oil, and they added .com to their name, Zapata.com, and so the stock went up 73% because of that. But ultimately, you have to monetize, and this gets back to value investing. We want to invest in businesses that ultimately will deliver profits to the bottom line, and sales, and hopefully sales growth as well along the way. So picks and shovels in the AI build out, we think is an area to invest in. And we own Digital Realty in the data center space. Some of these companies have been hit hard here of late. So Digital Realty, we just talked about that in this month's newsletter. A company called Eaton, which is an industrial name, that's another stock that's been hit hard. So those looking for non-quote unquote traditional tech might consider Digital Realty and Eaton Corp.
Thank you, guys. And I'll just encourage anybody, if you haven't read the artificial intelligence piece that Chris led us on, I encourage you to do that. A lot of good information in there. And just some talk too that we're at more of the beginning stages of this versus the end stages of this. So lots more questions, but we're on the clock. So I'm gonna we got a couple of questions asking just kind of around like, is there a reason to ever leave equities as you age? Does it depend on your investment portfolio, the amount of money you have? I won't let John answer it because we all know what he will say. But because, we always and will continue to believe that a good portion of your overall asset allocation should still be in long-term equities. It just really is going to come back to individual, right? Or a family. What are the ultimate goals? What's the time horizon? If, depends on your age, obviously that plays into time horizon, your ability to replace losses if there are some, your cash needs. So there's a lot that goes into that. And so what I'd say to the people that ask that question is, if you haven't done a financial plan, that you should do one. And we've had a number of our clients, been clients for a long time, that here over the last few years have gone through the financial planning exercise. I think, John, you'd agree that many of them either gained comfort or they've seen an opportunity that maybe they need to make some adjustments to their asset allocation because maybe they're ahead of the game. Or maybe they just need to change their spending plan or whatever it may be. But if you haven't done that, just to get the visuals, just to have the conversations, just to be forced to bring all the data together and put your goals in one place and then kind of look at everything, I would encourage you to do that. And we can always help people with that because that's a specialty that our firm has. Let's move on. Lots more questions here. And they're all around me, so I apologize that I'm looking around. So you've kind of touched on, but I want to go back to it. Although I have a long-term horizon, given that there is so much to be worried about, should I be accumulating more cash right now and waiting for a better entry point to put that cash or new money into stocks? So a timing kind of question.
Right. Well, again, as I said, the only problem with market timing is getting the timing right. The challenge is that you have to know when to get out and get back in, and getting back in is the hard part. Like I talked about with the pandemic, when would you have gotten back in? There wasn't a vaccine, there wasn't a cure, people were dying, the world was a mess all through 2020. And yet equities, the time to buy stocks was, March 21st of 2020 when we hit bottom, and things looked, abysmal at that time. So to answer the question, it really comes down to having the plan in place, and your income needs should be already addressed and met. And if you have, you need sleep at night money, we always counsel our clients that if the markets are causing you consternation and you can't sleep, we would suggest, taking 6 months, 1 year, 18 months of living expenses and having those dollars in quote unquote safe investments like treasury bills. So that's kind of how we look at it. There's the saying that the best time to invest is today, because no matter how you look at timing over the years, and Chris has run these studies for us, if you bought at the worst time of the year or the best time of the year, you go out 10, 15, 20 years, your total return is not a whole lot different, because that compounding is what you want to start the clock on. So I'm not suggesting that if you're sitting on cash that you need for next month, 6 months from now, you should put it in the market, because that's short-term money and that should always stay safe. But I don't think the actions we've seen today should cause you to alter your plan. Now, having said all that, your plan could have got out of whack because of equity returns being high. So if you're thinking you want to have a 70-30 allocation and you were 75-25, yes, maybe taking 5% off the table can make sense even after we've had this downturn. So that's kind of how I would look at it. But having the plan in place is what allows you to navigate through the scary times. So we all worry about it, but you don't need to make any changes to your plan.
That's important stuff. The asset allocation matters, like you said, and rebalancing can be a long-term contributor to overall performance. And that goes the other way, right? Too. So if we did end up having a market a 10% pullback or 15 or even a bear market, you can go the other way. So if you have that asset allocation structured where you have the more stable type investments, maybe high quality muni bonds or corporate bonds or somewhere else that you can draw money from to bring back to equities after equities have suffered a sell-off, to bring that allocation back into balance. That works well over long periods too, and we suggest that. John, we're down to about 3 minutes, so I'm going to try to get this one in, and I'm not sure if we'll get another one, and then we'll respond to many of the others on the blog or directly. But over long periods of time, mid and small cap equities have outperformed large caps, but this has not been the case over the past 10 years. Talk about a little bit about that, and do you see opportunity, and do you have any enthusiasm around small mid-cap stocks?
I know I got to be quick, but yes, the answer is we do see lots of opportunity in small and mid-cap stocks. Again, it's how we're wired. Things that haven't performed as well excite us going forward. That's where there can be greater value, and especially in small and mid-caps, you can have more mispricings, if you will, on the companies in which you're looking at to invest in. So we do have a small mid strategy that we run for clients. It's not something we talk about in the newsletter. It is a managed account strategy. You can email Jason or myself about it if you're interested in that. But absolutely, I think there's great opportunity in small and mid today. Chris, Jason, myself, Zach, who's on our team as well, we all have money in our small mid strategy as well as in our regular strategies. And I do think that for those looking to put new dollars to work, it's a great area to invest in, again, because valuations are so attractive relative to large caps, especially. And we're moving our portfolios more toward small and mid cap stocks gradually, of course, because we are all cap managers. But for those who truly want to have a small mid strategy, we have one, and we're happy to talk about it with folks.
Yeah, I think that's important to note, John, that our investment team and as well at Civitas, many of the principals and partners of the firm, we are invested alongside our clients. We wouldn't want to put you in stuff that we wouldn't put our own money in. And so we believe in what we do, and we spend a lot of time working on it. And so we have our own and our own family's monies in those strategies. As John said, all right, John, last one. Do you still feel confident? So in your outlook for the year, do you still feel confident in your double-digit return prediction for our brand of value stocks for 2025?
Well, I do. I mean, if you look historically, value stocks have generated 13% returns on average, going back to the 1920s. So if we think it's going to be an average year, that would be a 13% return. So that's the important point for people to remember is the stock market's not a casino. The odds aren't stacked against you. If you go to Las Vegas and you play long enough, you're going to lose. If you invest in the stock market and you play long enough, you're going to win, at least based on historical numbers. No guarantees about the future, of course. So we do think that equities will deliver solid returns this year. And I still feel confident in a double-digit return year for value. And of course, value has outperformed growth thus far this year, even though, the average stock on the marketplace is down, 4 or 5% on the year to date.
All right. Well, thank you, John. Thank you, Chris. As a wrap-up reminder, if you have any questions that you didn't ask, or you want to learn more about the newsletter, you want to learn more about our wealth management strategies and services, you can email info@theprudenspeculator.com, or you can see right down at the bottom of the screen in front of you, you can email me at jclark@covits.com or John directly, or you can call us. You can call me directly at 949-330-0901, 949-330-0901. With any questions that you might have about any of this, we just thank you for taking the time to attend and be with us today, and happy investing.